Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Dr. John Quelch, Dean of the University of Miami Herbert Business School, to discuss U.S.-China relations and international business. Dr. Quelch, it's great to have you with us. Welcome to Trade Talks.
Thank you.
Is the approach the Biden administration taking with China vastly different or in line with how the Trump administration approached it?
It's not vastly different. It's actually quite similar. And I think this has been a little bit of a surprise because I think most people expected the Biden administration to take a less hawkish approach towards China, but actually that has not happened. I think one reason for that is because the early meetings that took place first with Jake Sullivan, the National Security Advisor in Alaska, and then subsequently Wendy Sherman, the Deputy Secretary of State, went to China, as well as John Kerry. These meetings did not actually produce anything significant in terms of movement on the Chinese side. And so subsequently, with the Afghan withdrawal and now with the Ukrainian crisis, we have the foreign policy mechanism within the White House essentially distracted by these other pressing priorities. And so the amount of time that's been able to be paid to China is much less.
There's an increasing call to bring manufacturing back to the U.S. and our allies. Is that a possibility, or will China remain the factory to the world, or at least for the next few years?
I think it will remain the factory to the world. I mean, the fact is that China, like it or not, did a very good job of very swiftly locking down on COVID disruptions in factory plants and in ports. And the fact of the matter is that far from multinational companies relocating production to India or Vietnam in response to COVID in China, those other countries actually became afflicted with the disease and much less competent perhaps in quelling it. And so because China was able to keep COVID under control, it was able to actually sustain its supply chains, and there was no leakage to other countries of a significant nature. In fact, if anything, China actually reinforced its position as factory to the world by virtue of its tough line on COVID-related matters.
And you think that China is a major threat to U.S. IT dominance, but it's good for global consumers. Explain why that is.
Well, certainly, as Eric Schmidt pointed out in a recent Wall Street Journal article, China is catching up very much in the key areas of IT that will shape the second part of this century. But at the same time, the U.S. consumer has a very strong appetite for innovation, and U.S. innovation and R&D expenditures translating into commercial product and service innovation is a major feature of the U.S. economy and its sustained dominance worldwide. So while I would see China as closing the gap, I believe that the U.S. is well equipped to sustain its leadership in many of these fields, and that competition between China and the U.S. has to be good for global consumers. It's going to result in innovations coming online more quickly, and significant price competition, of course, is always good for consumers as well.
And how did COVID impact foreign direct investments, and what is your outlook there?
So I think COVID obviously had a dampening effect on all investment in the first year of the virus. People everywhere cut back on their capital commitments. But I think perhaps it made it particularly difficult for cross-border deals to be struck, particularly deals that involved parties that didn't necessarily know each other already. So when you're investing in new plant and equipment, for example, across borders, and you know and have known for many years the other parties that you're dealing with, it becomes much easier to do that in a virtual environment. But when you're not able to visit face to face and smell the room, as it were, where the negotiations are taking place, those kind of new greenfield type investments cross-border are a little bit more difficult to bring to a conclusion. So I think as we are in our private lives getting used to the new normal, so the investment community is also getting used to new ways of transacting, doing due diligence, other than having to, other than looking people in the eye face to face. There are other ways of compensating for the lack of availability to be able to do that, given restrictions on travel, which are still, of course, affecting much of the commercial sector.
And finally, when do you expect global supply chains to return to normal?
Depends on the product. I think that if you're talking about a relatively simple product with multiple sources of supply, then of course the product supply chain should be restorable relatively quickly. But if you're talking about items that have specialty components from which there are only one or two sources of supply, and maybe one of those is disrupted for whatever reasons related to logistics or related to COVID in particular, those are going to be more difficult to bring back to normal. One thing I would point out regarding the supply chain, though, I've come across many companies that have experienced tremendous volume increases in demand during the last year. And they have, of course, not been able to fill all of the demand, but they've been able to fill a lot of it. So the supply chain actually did flex quite effectively to accommodate increased demand that had been unexpected. It just wasn't able to flex enough to accommodate all of the increased demand that came through as a result of the pandemic, especially for, goods and services, goods in particular that were being used by households around the world as they were shut in from spending money on experiences and restaurant dining and so forth.
All right. Dr. Quelch, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.